Okay, I'll go ahead and get started. So thank you guys again for coming to the last session. We're almost there. You guys excited? We're going to wrap it up. So my goal for this class is to really get through a lot of the content, to actually go back and review some of the things that we've already talked about to make sure you guys grasp it. Because it's not just about me coming up here and talking to you guys about investments. I want to make sure that you guys understand, you understand how to actually analyze how to make your money work for you, okay? So in this session, what I'm going to do is, like I said, I'm going to go back and we're going to do a little quick review. We're going to do a stock reading exercise again, so to make sure that you guys remember some of the concept that we talked about from the last class. And then we're really going to focus on mutual funds, index funds, ETFs, and then lastly finish up with how to put an investment strategy together, especially when you're looking at your retirement portfolios, okay? And then what I'm going to try and do is that hopefully we can get through all the content pretty quickly. I'll leave the last, let's say hour, let's say 45 minutes, to letting you guys ask whatever questions, whatever things might be on your mind, things that maybe were not clear, so that you guys are able to really understand the concept and the concept when it comes to investing. All right.
Is our real estate guy going to be here?
Yes, he told me he was going to be here, so he's going to be, you're going to be able to ask questions both on real estate and also market investment. I think he's also driving. So. All right, so I saw this quote by Benjamin Graham. For those of you guys who don't know who Benjamin Graham is, he was the mentor for Warren Buffett. And he talks about how successful investing is about managing risk, not avoiding it. When you look at investments, a lot of what we want to do is we want to avoid risk. We want to avoid doing this. You put your money here. You don't know if your money's going to go up or if your money's going to go down. But everything in life has risk to it. So what you want to do with investing is understanding how much risk can you tolerate as an investor, and figuring out how you actually can manage that risk so that your investment portfolio closely models the risk that you can tolerate as an investor. Make sense? All right. My standard disclaimer, these are all Loretta's ideas. I'll talk to you guys if we get a chance. I'll talk to you about some of the stock investments that I've made. I'll give you guys why I've made some of those investments. But again, I'm not a financial advisor. I'm not a financial planner. Neither am I an accountant, etc. These are Loretta's ideas. So if you guys want to follow what I say, great. If you don't want to follow what I say, that's perfectly fine. I won't be offended. But what you can't do is come back and sue me for anything that I say. All right, so I told you a little bit about what we're going to do with the agenda, so let's skip over. So let's go to a review session really quick, and this is active participation, so I want you guys to make sure that you got the concept that we're talking about. So the first question, how much money should you have saved at all times?
3 to 6 months.
Good, yay, 3 to 6 months. All right. What is the litmus test on if you can afford a depreciating asset?
If you could pay for it in full.
Perfect. If you can pay for it in full. All right.
And still have 36.
And still, thank you. And still have, yes, if you can pay for it, if you have enough cash to pay for that asset or whatever, right, and you still have 3 to 6 months. And remember, this is depreciating assets, right? I'm not talking about things like buying a house. You don't need to have enough, the cash to be able to buy. Yeah, I know, right? I'd never buy a house for a long time. Okay. All right. How hard is money working for or against you? Is also no. It's also known as what? Just. Those are different types of investments, but there's something that I told you guys that you know how hard your money is working for you. It's what?
When you can get money as you're sleeping.
Yes, when you can get money. But what do you look at? What do you look at to know if money's working for you or not? Anyone?
Interest.
Yes, your interest, your rate of return, right? So if you think about it, if you are paying credit card debt and your interest rate is 22%, that's your money working against you, right? Because you are paying 22% of interest.
However, if you're investing money and you're getting a rate of return of around 4%, then that's your money working for you. Does that make sense? So your interest is always what you look at to know how hard your money is working for you. All right, next question. What is one reason why you should contribute to your retirement account?
So then when you're old, that you have money.
So when you're old, you have money. That's a great reason. What's another reason?
Why not?
Why not? No, but what am I looking for? Why does the government have these retirement accounts? Exactly. These are all tax advantaged accounts, okay? So you want to make sure that you are leveraging all the different ways the government has provided so that you have the tax incentive to be able to build money for retirement. Who is texting me? Oh, somebody's downstairs. Okay. Next question. What is a good way to gauge how much money you need to save for retirement? Remember, I told you that I use a lot of... Yeah, there are calculators, but remember, no calculator is going to give you the same. It's going to give you the same amount. So what was the way that I told you that you can actually use to figure out how much you need in retirement? There's a rule, and it has to do with how your money lives in perpetuality. No, not rule of 7.
The 4% rule.
Yes, the 4% rule. So remember, if you guys remember, the 4% rule is how much money, if you take however much you end up in your retirement account and you are withdrawing 4% of that money, that's how much money you would have. So let's say I have $1,000 and I take 4%, sorry, not 1,000. Let's say I end up in retirement, I have $1 million, right, in my retirement account. And 4% of $1 million is what? $40,000. So I can pull out $40,000 to live on for the year. And the goal is, the reason they say 4% is because that's how much they estimate that you can also get back in your retirement. So you eventually get close to that 40%, or sorry, close to that $40,000 back. So 4% is how much they recommend that you take out so that your money does not run out. Make sense? Wow. So if you think you're going to be living on $100,000, you need $2.5 million, okay? All right? You better make a budget. Exactly. Who can remind me, and I don't have this on here, what is the rule of 72? Do you guys remember 72? Yes?
Your money doubles.
Uh-huh. But how does it double?
Is it something times the interest rate?
Yes, not times, divided. If you take 72%, remember I told you that your interest rate is your money, how hard your money is working for you. If you take 72 divided by your effective rate of return, so let's say you're getting 8% back. I just picked a hard one. What's 72 divided by 8? Is 7? 7, right? 7. 9. No, 9. 9. Yes. Yeah, see? There you go. Oh, you should have told us, like, y'all ain't smart. So if you take, I know. So if you take 72 divided by 8, right? Let's say your rate of return, you're getting 8% every year over year. Then it's 9, right? 9 years is how long it's going to take for you to double however much you have in your retirement account. That's the rule of 72. Does that make sense? Everybody got it? All right, fantastic. All right, at what age can you withdraw from a retirement account without penalty? 59.5. Perfect. 59 and a half. All right. All right, 59 and a half is the age at which you can withdraw without penalty. You can tell me there are two major types of retirement accounts.
401k.
Yes, but what are they called? Yes, Roth and 401k. What's the main difference?
One is like under the
No, what is it? Huh? Yes, the way you get taxed. So what is it? It is a tax. You're either paying taxes now or you're paying taxes. Exactly. Either way, you're paying taxes.
401 you pay taxes later.
Exactly. So 401k, you pay taxes later, and in a Roth, you pay taxes now. All right, makes sense. Welcome. We're just doing a review. Do you guys want to sit and move my bag? Or you can move those chairs. All right, so let's see, what other questions do I have? So you pay taxes now, you pay taxes later. If you guys remember, when you pay taxes later, there is something called an RMD, right? Required minimum distribution age.
Oh, you have to get on.
Yes.
taking it.
Yes, 70 and a half, I believe it's 70 and a half, yes. And that is the age at which you must start pulling money out of that tax-deferred account.
That one too.
Any tax-deferred account, you must start pulling money out at 70 and a half. All right, more questions. This goes to the last class. What did I call the big D's of investing? There were 2 D's. Yes. Yes, discipline and diversification. Those are the 2 big D's. Those are the key things that you need to remember when you're investing, okay? You need to make sure that you have discipline to be able to follow your strategy, and you need to make sure that your portfolio is diversified enough, all right? All right, what 2 emotions do you have to watch out for at all times?
Fear and greed.
Fear and greed. And this goes to the question that you asked me, like, pros is going down. Should I sell? Because you're like, your money is going to go, whatever. And what fear will make you do is fear will make you sell an asset before you need to.
But aren't there times that fear is actually...
I won't say that it's not good. Yes, but see, here's the thing, right? Is when you invest in something, you're investing for long term. There needs to be a reason why you're investing for long term. What fear makes you do is that it makes you change your investment strategy. So take, for example, we just talked about our company's stock, so PROS, P-R-O. And they were shooting up. At the beginning of the year, it was $30. At the high, it was like 74 something. Right now, it's at 64 something. And it literally has gone down by like $10 over the past 2 weeks. And so we're having a conversation like, why is this happening? Should we go ahead and sell now? And I'm like, no. I said, look, you're just along for the ride. And typically when you see, remember I told you guys, when you see a stock going up or you see a stock going down, if it is going up higher than what the market average is, there's a reason why. If it's going down lower than what the average market is doing, there's also a reason why. So you need to understand what the underlying reason of why a stock might be shooting up or why a stock might be shooting down. Okay?
Can I add something
Yeah.
to that? Like you said, Pro, that's your company. You work for that company, right? I know that if I kind of listen to what the upper management and my company is doing and listening to some of what they're saying, it always is an indication of if the stock is down, not to be concerned.
Mm-hmm. Yes, they'll always. So the one thing I'll tell you about with executive staff is that they're there to try and make sure your shareholders don't freak out, the employees don't freak out. So sometimes I'll take what they say with a grain of salt. But overall, with regard, where I tend to listen to them is to understand the trajectory of the company.
And what they're doing moving forward.
Exactly.
Watching the steps that
Exactly.
they take
Exactly.
year after year within the organization.
Exactly. So if you take, for example, like we had a conversation yesterday about cable companies, like people like Comcast and Xfinity. Oh, sorry, Comcast is Xfinity. Yeah, it's Comcast, Time Warner, AT&T, et cetera, right? You have a lot of people who have cut their cable, right? So you see their revenue has basically gone down sharply. So when I'm listening to them, it's not, if they tell me, oh, don't worry about it, I know there's, okay, come on. You got to,
You have to
yes.
see what's going on in the
Ex-
day-to-day
ex-
activity of the company as well.
For the teams, so they can use teams.
Oh, so, okay. It's just at PROS, P-R-O-S. Yeah. All right, let's keep going. What types of bonds are there, and how can you tell if a bond is good? What is a bond? Let's start with what is a bond. Who can remind me, what is an easy way to remember what a bond is? Anyone? A bond? Look at her looking at her notes. Anyone remember what a bond is?
The government.
It's an IOU.
Yeah.
Remember, in every single other investment type, you are an owner. Okay? When you buy a stock, when you buy a mutual fund, when you buy a commodity, when you buy real estate, you are an owner. You own something. Now, you don't, not necessarily is a physical something. When you're buying stock, you own a share or a piece of the company and a piece of the profits. When you are in a bond scenario, you are a lender. Okay? So Chitara comes to me and he issues a bond for $10,000 at a coupon rate of 8% or for the next 10 years. So he gives that to me and I take that and I take his bond. So basically what I do is I give him $10,000 and over the course of the next 8 years, he's going to give me 8% interest rate. And at the end of the 10 years, he's going to pay back the principal in full, so the $10,000. So that is basically what a bond is. So Augie, when we were talking about pros, give you guys an example. What happened with my company is that a couple of years ago, they issued a bond for $100 million. So they sent to investors, people who want to invest in the company, we need $100 million. So different investors took that bond. They were called convertible bonds. So they took the bond and there is a specific or a given interest rate over the lifetime of the indicated lifetime of the bond. Does that make sense? All right.
Yes.
All right, good.
So the interest rate per year annually or over the lifetime of the entire?
It is, they actually pay out the interest rate semi-annually, so twice a year. Yeah. All right. What types of bonds are there and how can you tell how good a bond is? Anyone remember? Yes.
Government bonds?
Yes, they're government bonds.
Junk bonds?
There's junk bonds.
There's something else.
But so you mix up two concepts. So there's government bonds. So there's federal bonds, government bonds. There are municipal bonds, and then there are also corporate bonds. So a corporation can issue a bond. The U.S. government can issue a bond, and state and local governments can also issue bonds. Okay. Now, how you can tell how good of a bond is, remember, it's similar to your credit rating. So every single bond has a credit rating, and they call them either investment grade bonds or they call them junk bonds. So that's how you can tell how good a bond is. Make sense? Yeah, we're all here. Nobody's completely lost. Good. All right. What's a commodity? This one's a hard one because I know we didn't talk a lot about it.
Something that comes out the ground.
Yes, it's something that comes out of the earth. Perfect. You guys are listening. I'm so proud of you. So commodity is anything that comes out of the earth. So you think about things like oil, wheat, corn, gold, etc. Those are all classified as commodities. Okay. Let's look at stocks. What is another term for a stock? Yes, equity. All right. You hear the term stock, you heard the term equities. They can be used interchangeably. They mean the same thing. Okay? All right. We're good? Everybody's following so far? All right. I wanted to put some corrections. I went back and I actually listened to the last session, and there were a couple of things which I didn't tell you guys the right thing, so I want to make sure that you guys have the correction. So the first one is on market cap definitions, right? So there are lots of different types. There's small cap, mid cap, and large cap and mega cap. Actually, let's stop. Who can remind me what a market capitalization is? Market cap. Y'all know this.
Like what they're worth?
Yes, the value of a company. Okay. If you look at the market cap, the market cap defines the value of the company. Who can remind me how market cap is calculated?
The stock price versus the outstanding shares.
Exactly. You take the stock price, so however much it's trading today, times the number of the outstanding shares. And that's how you determine what the market cap is, okay? So you have companies that are classified as small cap. And I think what I told you guys were the wrong ranges, so I just want to correct that. So small cap is 300 million to 2 billion. Mid cap is 2 billion to 10 billion. Large cap is 10 billion to 200 billion. And then mega cap is 200 billion. Okay? And the reason why I wanted to correct this is that when we go into the part where we're talking about how you put together your investment strategies, you need to know the size of the companies you're invested in. Okay? Whether it's a large cap, large blend, you'll hear large blend, you'll hear mid blend, you'll hear large growth, etc. So you need to understand when you hear that, it automatically should trigger, oh, they are a company that has a valuation that is over X amount. Make sense? Fantastic. All right. The next thing that I wanted to make sure that I pointed out, volume, right? And we're gonna go into the exercise. Join. Yeah, sorry, give me one. Can I join when we do the exercise? Yeah. Okay. So we're gonna go do some exercises later, but one of the things I wanted to point out is that the volume is actually the number of shares that are traded on any given day. Okay, it's not the number of outstanding shares, because I think I misspoke when I pointed that out to you guys. So when you're reading a stock chart, you'll see average volume and then you'll see volume. So the average volume is the average of how many shares are typically traded, and the volume is how many shares were traded within that given day. Okay? All right. PE ratio. Oh, sorry. PE ratio. Remember, I was struggling a little bit to define how you think about PE ratio. Remember PE, well, let me ask you guys, who can remember what PE ratio stands for?
Without cheating.
Huh? Well, I mean, yeah, but how do you calculate? What I'm asking, yeah, price to earnings, but how do you calculate it?
It's the stock price divided by the earnings per share.
Yes, it's your stock. That's what I was looking for. It's a stock price divided by the earnings per share, and you'll see what the earnings per share are, right? If a company has a negative earnings per share number, they don't have a PE. Okay, that means that they're not profitable. Does that make sense? Okay. So, and then it's also the relative way of valuing a company. So the average PE tends to be between 20 to 25. However, you'll see some companies, like if you were to look at, remember we looked at Amazon, their PE ratio is like almost 100 or something close to that. And that's because investors are willing to pay more for that stock because they believe it has really great growth potential. When you see a high PE, it means that they are a growth company. When you see a lower PE, they tend to be a value company, okay? So more established companies, you think about people like ExxonMobil, even I looked at Parker Hannifin. Parker Hannifin has a low PE. You guys also have a low PE. So these tend to be more stable value companies. Now, however, you will get, I wouldn't call them unicorns, but you'll get companies that have low PEs but have really great growth potential. So somebody like Apple, I think Apple's PE is around 15 or 16. We'll look it up. And they have a low PE, right? Meaning that they're actually making lots of money per share for their business model or for their business, but they also have great growth potential.
Weird.
Is there another metric of growth other than PE?
For growth, it's not really to be honest with you, it's not really a growth metric. It just helps you to understand if you're overpaying or underpaying for a company. Yeah. All right. Good? Good so far? Clear as mud? Everybody's good? Nodding your head? All right, good. All right, let's review how to read a stock chart. Yes, everybody pull out your app. Pull out your app. All right, who can give me, what stock chart should we read? Somebody give me an example of one that you would like to read. Anyone? Starbucks? All right, I think the SBUX, right?
Yeah.
Let's look at Starbucks. SBUX. Okay, you guys have Starbucks pulled up? All right. First question, what stock exchange is Starbucks traded on? Somebody told me it says it on there. NASDAQ, perfect. Do you guys see where it says NASDAQ? Does everybody see where it says NASDAQ, or are we?
Yes.
I'm going to pull it up on the screen too. Which kind NASDAQ? All right. It says somebody should let me in soon. Okay. Okay, do you guys see right under here? This is how you know what stock exchange, right? And who can tell me, does it really matter what stock exchange the stock is traded on? Okay, good. And what are the two major stock exchange here in the U.S.? No. Yeah, that's an index. What are the two major stock exchanges? No, not Dow Jones. You guys are mixing up index. We'll get to index. And New York Stock Exchange. NYSE. I know, it was an easy one. Okay, all right. So who can tell me what is the market cap for Starbucks? Yes, $114 billion, right? So what type of company are they classified? They're large. No, they're a large cap.
Yeah, because they're billion.
It's still saying somebody will let me in. All right, so they're considered a large cap company. Why?
Because it's in that range.
Yes, perfect. Okay, are they profitable or not profitable? That was you? Okay. All right, are they profitable or not profitable? How do you know they're profitable?
It's not in the negative.
They have a PE ratio and what? No, not beta. No. Well, that's a good way because you won't pay out a dividend if you're not profitable. Yes, their earnings per share, okay? So you see that they have $2 for every share. They make $2.80. Okay? All right. And you calculate your PE by doing what?
Earnings per share, the stock price divided by the earnings per share.
Exactly. So 95.74 divided by 2.8 is how you get that PE ratio. So are they overvalued, undervalued? How would you define them? They're growing. All right. So they're growing. Their earnings, they have a high PE ratio, right? So if I'm analyzing this to see if it's something that I want to buy, I look at it and I say, ooh, this stock price is actually pretty high. So what is their growth trajectory or growth potential? I probably personally might not touch Starbucks because I feel like a lot of people are paying a lot more for Starbucks than they probably should. Does that make sense?
Okay, so can you do that again?
Mm-hmm.
Okay, say that.
Yeah.
Tell me the reason why.
Okay. So the average PE ratio for companies is between 20 and 25, right? Mm-hmm. These guys have a PE ratio of 34, which is pretty high, higher than the average. That means that you are paying when you pay $95
more than you should.
Exactly.
So I was going to ask that question a while ago. So once you get past that 25, you're really paying too much for
it. Might be. So if you go and you look at somebody like Amazon, let's look at Amazon real quick because that's the one I can think of off the top of my head. AMZN, if you want to follow in your app. All right. So look at their PE ratio, 76. Mm-hmm. All right. So you're paying a lot for Amazon. And it means you're paying a lot compared to how much they're making today. However, remember I talked about their growth trajectory. People are willing to pay more for Amazon right now because they believe in lots of other things that Amazon is doing that's going to end up earning more money. So is there a specific formula to say if there's a high PE ratio that's over 20, PE ratio that's over 25, don't pay for it or don't buy it? No. I own Amazon stock, okay? And I have a company that has, they call it, they'll say it's overvalued. However, it might be overvalued, but there is really growth, great.
You see something.
Exactly. So when I say that I might not pay for Starbucks at that price, it's only because me right now as an investor, I do not understand what their growth potential is long term to be able to increase their profitability. They might have it, but I just don't know. And this, yeah, and this is part of the reason why I always say don't invest in what you do not understand. Okay? Make sense?
I have a question.
What's up?
So Amazon's PE ratio is not, it's not calculated by that formula that you did with the PE ratio,
Yes, it is.
right?
If you take earnings per share, the price, 1,833 divided by 24. It should be.
My real question is this fair value indicator?
Where? Fair value, yes.
Is that basically PE ratio?
This is based on analyst inputs. So you'll see, can you see the analyst recommendations? A lot of the analysts recommend that it's a buy. In fact, if you are in your app, so there are two tabs on my app at the very top. There's summary and there's the details. If you just scroll over or you click on that details tab, you'll see what their revenue is and you'll see what their earnings are. You can actually see the map. And you can see what the analyst ratings are, the analyst recommendations are. And you can also see what the price targets are. Okay? Does everybody see that?
Yeah, I don't see where it says analyst buy or not buy. I see their target.
Look, the analyst is right underneath the chart right here.
So it says, okay, analyst recommendation ratings 2.5. What does that mean?
Should I?
Mine says 1.7. And
It's
it's,
the
it's
desktop.
towards this strong
Okay.
buy.
Okay, I see it. You see it? Yeah. So it says
Okay, so everybody see it?
Yeah.
So the analyst recommended rating is 1.7, right? Strong buy. Can you guys see that in your app? It's a strong buy rating. They believe the average price for Amazon is $2,269. Oh, she in the wrong one. It's okay.
So do you think those analyst suggestions there are pretty accurate?
Yeah, I honestly take some of them with a grain of salt. A lot of them I will listen to. I'll hear why they recommend it, and I'll try and read, because what you'll see is that
You go do your own research.
you got to do your own research. You'll see a lot of analysts make like recommendations. So you'll hear something like they have upgraded the stock, right? They've upgraded it from a hold to a buy. That's what it's called, an analyst rating upgrade. And when they put it at a buy rating, they'll also set a price target. You'll see the stock move whenever an analyst upgrades a stock, or they downgrade a stock, or maybe they'll say that they slash the price target or they increase the price target. These are analysts telling you how much they believe that the stock is worth. Yes.
So, do you know that there's another Amazon.com? I don't know.
Which one?
3,000. What's that?
Which one? AMZN. What's it called?
Is that accurate?
No, I don't know who that is.
So they are allowed to,
They might have different
like a
derivatives or something like that, but I don't know. I'm not familiar with who that is. Okay. All right. Back to the, what do you call it? So, do you guys have? So we're looking at Amazon. How much a stock moves up and down relative to the market is called the what? That's how much you're trading per day. How much it moves relative to the market is what? Yes. The beta. Remember, if you have a beta that's over 1, it means that you move more relative to the market. If you have a beta that's under 1, as the market is moving, you don't move as much relative to the market. Okay? All right.
And what's the value of that information?
It just helps to tell you how much your portfolio is going to swing. So it helps you to understand the volatility of that stock.
Could it tell you the stability of the company?
It could also help you, not of the company, because everything is also of the stock. Bless you.
You said over 1 is what?
It's more volatile relative to it's relative to the market. Okay. All right. Do you guys have any other questions around reading stock charts?
Thank you for going over that with us again.
Yeah, I do.
Yes.
So this indicator, right, this fair value indicator,
Yes.
it's going to, because the Starbucks indicator had an overvalued, what do you call it? I guess it was overvalued, right?
Mm-hmm.
Does that depend on the range that it's in? Like, for example, the market cap, this is like a mid-market cap.
No.
Starbucks isn't.
Has nothing to do with that. It's most likely, because I actually haven't seen the overvalue, undervalue, but it's most likely the analysts telling you what they think about how much you're paying for that stock. So remember the valuation, right? I told you if you have a high PE, it's a high valuation, right? But the reason you saw Amazon is that although they had a high valuation, they have a lot of growth trajectory.
Is that something that's like expected from somebody with a high market cap? Somebody with a high market cap?
No, has nothing to do with market cap. Market cap just tells, I see where you're getting it mixed. So market cap tells you the value. When I say the value of the company, it means how much the company is worth. Now, this tells you how much you're paying for each share. It talks about how much you're paying for each share. So if I'm paying $95.74, is this a good value? All right. And when you think about, is this a good value, $95.74, you're also looking at the PE ratio. So the PE ratio for Starbucks is high. Remember I told you that the PE, and I said I'm not sure if this is something that I would invest in. And what the analysts, although they have a buy rating, they also believe that it's overvalued.
The PE ratio for Amazon is double.
Yes, but Amazon has growth potential. All right.
That you can't calculate.
Yes, they might be looking at. They actually have something called a forward PE ratio. So they believe that if they do a run rate of where Amazon is going to get to, what is their forward PE or future PE.
So, is there a research tool that you recommend? So if you're trying to research at a company and trying to get into what's behind the scene, like say like for instance, you're interested in Starbucks, but you really want to say, okay, is there a growth potential? Do they have a roadmap? Is there a tool or is it just a combination of things?
I don't really have an easy tool that I use because you've got to. Here's the thing with looking at investments, you have to read more than one source. Huh? I don't know what happened. The TV turned off. So you've got to read more than one source if you're trying to analyze if you're going to invest in something. So I'll read news from Yahoo, I'll read news from Fidelity, I'll read it. And these guys, the reason why I use this is that they aggregate news from lots of different outlets. So Market Watch, maybe Forbes, etc. Lots of different places. And I'll read all of the different news to try and make the best decision. I don't invest in anything that I don't really understand and I don't believe in. So if you look at all the assets that I have some working knowledge of how their products work, how their services work, etc. And I can make a best.
Understand the company to some
Yeah.
degree.
Yep.
To piggyback off of that question, because I think that's a really good question. Is there something that, I know you said there's no magic tool that aggregates all the data and tells you this is the growth potential statistically, But in terms of the indicators, I guess what's the closest indicator to some sort of quantifiable
Way.
growth potential?
So here's the thing you have to realize, like we're talking about growth potential, but remember, if you remember, I talked about how there are lots of different ways to invest. You can invest in growing companies, right? But remember, those tend to have a riskier profile because those will have a higher PE. Then there's value companies, right? You have people like your Exxon Mobils, you have your Caterpillars. These are steady eddies, right? So if I am looking at growth potential, the way I tend to analyze it is I'll look at their PE to say how much are people paying for this now? What do they think they can do in the future? And I don't necessarily only look at the revenue numbers. I look at things like what markets are they in? What industries are they trying to break into? What kind of traction? Who are the main competitors in these industries? So take, for example, let's go back to Amazon, right? Because Amazon has a high PE.
It was like 76 point.
Yeah. So they have a high PE. But part of the reason why I'm invested in Amazon, one, they're the de facto e-commerce giant right here in the United States. And the other thing is, the other thing is that they are also, they've got AWS, which is a growth trajectory for them, right? So if you look at how their cloud services are growing, they are moving they're moving in that direction. And that's part of the reason why I invest in them. So unfortunately, there's no magic way to be like, oh, how can you tell me what the growth opportunities are? You can read a lot of analyst reports, you can read a lot of their ratings, but I think just getting a lot of news from a lot of different sources is also helpful. So another example is Match. So remember I told you guys that I have Match stock, that I bought Match stock for my niece. They are the parent company for Tinder, right? So, but if you look at something I'll look at is like, what is their current market share here in the United States? Are they saturated? Do they have an opportunity to grow? What are some of the other ways that they're trying to grow? So Match also released like an app for, a dating app, I think for people in Asia or something like that. So a lot of investors saw it and they saw, okay, they're not only now saturated in the market, there are other areas in which they're going to be growing outside of the market. Same thing with Netflix, right? They released a low-cost streaming app in India. So these are different things that I'm looking at as to, okay, how are they planning to grow their company? How are they planning to grow their revenue? So unfortunately, you just have to stay on top of the news. Oh. Okay, makes sense? There really isn't. A lot of people are able to look at earnings reports. They're able to read, an earnings table and be able to make decisions on whether they should invest.
Simple though. What's your own guiding principles? About what are your what's if you
I don't remember.
Where do you start from?
Did I include it?
I'm asking.
Hold on.
Okay.
I showed you guys these. Let's go back to 2.
So I would start by stuff I know.
Okay.
I would just, like she said, she picks companies, and correct me, I'm speaking out loud just to make sure I have it too. But stuff that I'm familiar with would be a good place for me to start.
Yeah.
Because at least I have some knowledge of industry, company, something.
So you start from what you know, you add knowledge to it.
Yes.
Right.
Without knowledge.
Yeah, because so there's no emotional behind.
Yes. So here's the thing, right? Do I recommend for you guys to go off and pick a stock tomorrow or whatever? No. Stock investing, like you need to get a liver for that one, right? Because it's gonna go up, it's gonna go down. Remember when I said that the greater the risk, the greater the reward, the greater the risk, also the more you can lose, right? And part of what you want to do is you want to diversify your portfolio. So I'm going to talk a little bit about how mutual funds diversify the risk. They take out the risk in your portfolio because now you have fund managers, yes, who are investing in assets that you might want to invest in, but they do it indirectly. Okay? Now, if you guys remember, these are the ways that I said that I tend to take a look if I want to buy an individual stock, right? I'll look at things like what is the company's value, and you can tell the company's value from the market cap, right? How big is the company? Is it a fair price for the company? I can tell that by the PE ratio. Are they profitable? I can tell that by the EPS. What market is this company in? I got to do some research on that. What's their growth potential? I also got to do some research on that. Is there any competitive threats that can prove catastrophic? So let me give you guys an example. A few days ago, so remember I told you that I invested in Match, which is a parent company for Tinder. Well, Facebook a few days ago just announced that they were going to be doing online dating. So you know what happened to my Match stock? It went down by like 5-6% just in that day, just from that announcement, right? Did I go off and freak out and sell? No.
Maybe Facebook dating won't necessarily take
Yes.
off.
Yeah. But then exactly. But what happened was that you now have a new competitor, a big competitor that has now come into exactly. So I have to analyze, okay, what does this mean? Right? In the same way, remember I told you guys the Dropbox example, they're a small company, right? And they do a lot of cloud services, but the reason I never invested in them, I'm like, you're playing with big boys like Apple and Google, and I mean, what's your value? I don't get it. I don't see how you guys are gonna have a good trajectory long term unless you get bought out. So that's part of the reason why I didn't invest in them. So the other thing I will look at is the company buying back its own stock. If they're buying back their own stock, then they believe in their stock potential. Do they pay out dividends? Also look at this. I'm not a dividend investor, but
What's the effect of buying back their own stock? What does it do for them?
it actually increases the stock price. So let me step into the political world a little bit, although my dad won't let me, or he's gonna say something. So when they actually had the tax cuts last year, one of the major things that a lot of corporations have extra money, right, because they don't have to pay as much in taxes. And part of what they talked about doing was using that money to whether hire more, pay higher wages to their employees, etc. But what a lot of these people did was they had stock buybacks. What that does is that it naturally increases the value of the stock. And so you're putting money back into the pockets of the shareholders. All right. So what stock buybacks will do is that people believe it's like, our stock is undervalued. So we're going to buy back our own stock. We have that stock now, and it automatically, the stock price will go up. Okay. All right. Do they pay out dividends? Does the company have a lot of debt? Do they have a lot of cash flow? If cash flow is especially important, remember I said in this environment where a lot of corporations are not corporations. There are indicators of a recession coming. In a recession, you need to have cash. That's why I keep telling all of you guys, make sure you have at least about 6 months worth of living expenses saved up. So you need to have cash. And so the question is for the company that I'm investing in, do they have cash to be able to weather a recession? If they don't have cash to be able to weather a recession, they will go under. Yes?
So if it's going to be a long answer, I can answer later. So what was the strategy of Apple last week? Where they are sitting on under $1 billion and now they are loaning $7 billion. What's the strategy? Is it that they believe that recession is?
I don't think it's a believe. I think I haven't looked into it. I heard that, but I think part of it also is because money's cheap.
Okay, so for an investor, when you see a company do something like that.
Somebody like Apple, no. Somebody like Apple, it's a blimp. I won't even, because they have way too much cash for me to even care.
Yeah, but that was a question. Like, they have too much cash.
Mm-hmm. Maybe they're using the cash to do something else. If money's cheap, if I can borrow money from you at 0%, right? I borrow $100 million from you at 0%. I can take that $100 million and go make even 3%, right?
So-
My money's doing more for me, and so I'll borrow the money. So I don't know. Let me preface this and say that I don't know, but in my mind, if money is cheap, then why not borrow it? That's why pros borrowed the $100 million, because borrowing money was cheap. Okay? What are the analysts saying? And then, am I willing to hold the stock? Do I believe in the growth potential, not just in the short term, but for the next 10, 15, 25 years? I told you guys, give you guys, going back to the example of Match, right? I believe online dating is here to stay. That's why I'm invested in the stock. Okay? All right. Let's go back.
And you get a lot of that information just by doing internet research.
Yeah. So one of the things I want to make sure, not you, if you have you guys all have your what do you call it? Yahoo Finance app. You can create watch lists. Okay. I have 2 watch lists on Yahoo Finance. Let's go back. Let's go here. I have watch lists of stocks that I'm looking at, companies that I want to buy but I haven't bought yet, and I have watch lists of companies that I own. What Yahoo Finance does is that they aggregate news, just market news. You can go into any company. So here you can see my watch list here. So see VMware.
I think they do that on this stock app on just your iPhone.
Your stock.
Yeah, they probably do.
Can I add just one more tip? So I use Robinhood, and they also have a watch list. They track a lot of the same indicators, and they have alerts for when their earnings calls. So
Yes.
you'll get the alert. Facebook earnings call is happening right now, so you can just dial in and listen in immediately. You can hear everything and all the companies that you watch, and that's also a good source of
Yes, news.
research information.
Yeah. And
It's
yes.
Yahoo Finance.
And Yahoo Finance also will give you. They don't give you an alert when the earnings call is actually happened, but they'll give you an alert of the results of the earnings calls, or the results of the when they actually post their earnings.
Through Robinhood, I mean, it's like just one click down.
You get it.
Listening to Elon
Yeah.
Musk talk about
Tesla, yeah. And the thing about it, like I said, is there is no magic app or whatever. I use Yahoo Finance. I use Fidelity. I used to use TD Ameritrade. He uses Robinhood. It's wherever you can get news. Okay, so it doesn't matter who or what you use. So these are all the companies that I am invested in. If I look in my app right now, what I will see is there is actually a news section. You can go and it'll give you all the news around the companies, what's going on in the market. If you actually click into a company, so Alibaba is one that I'm invested in, and you scroll down, it'll give you a lot of the up-to-date news around around Alibaba. So it'll give you a lot of information around each individual stock. Okay? Everybody good? All right. All right. Any other questions on stocks before we take a break? Yes.
Like, let's say I don't know the acronym or whatever. If I were to just type in like Twitter, like 3
Yes.
things come up, how do you know which one it is?
Twitter, 3 things come up?
Like,
Yeah.
if I literally just type in the word Twitter, it would say NASDAQ.
Oh, can you see equity NYQ? Right? There's Twitter. Whenever you see that .mx, .be, that's typically not the real ones. So it's TWTR.
Okay.
You see it?
So what are the other ones if those aren't the real
I don't even know where those. Do you have any idea?
Some of them have countries.
Yeah, I think that's where you can trade that symbol outside of the U.S., but I don't know.
You'll also see the full company name underneath the symbol, right? And I've never seen full company names under 2 different symbols. Without some sort of
Unless they have.
If it's another country, there's a
Yeah.
Amazon Mexico, but it's
Yeah.
trading pesos.
And then the prices.
Oh, this is Mexico.
Yeah, it's not here. Okay, all right. Here is what I want. Oh, I remember before we go on break. So you guys remember I told you that there are different types of stocks you can look at. So they're growth, value, dividend, and IPO. This is just a slide from last week, okay? I'm not going to belabor this because hopefully you guys remember. Any question? No? All right, fantastic. All right, executing a stock order. I forgot that I wanted to talk to you guys about this. When you place a stock order, right, what happens when you're buying a stock, are you buying a stock from the company? The answer is no. Okay? Remember, a broker is somebody who brings buyers and sellers together. You're actually buying that stock from somebody who already owns that asset. Okay? Somebody who's willing to sell. Whether the seller is the CEO or the seller is Genesis, she owns that asset and she wants to sell it to me, all right? So what happens is that you say, I want to buy a stock, and you can put lots of different transactions. You can say, I want to go with a market order, right? A market order basically is just I want to buy the stock at whatever the market is trading at this very moment, okay? So if, let's go back to, let's go to Fidelity, right? If I want to make a trade, I can, don't close, damn it. I know. And this is just using Fidelity as my brokerage firm. You can do this with any brokerage, Robinhood, TD Ameritrade, Merrill Lynch, etc. Yes, they do. Yeah, they do. So Fidelity charges $4.95 for every trade. Like Bank of America, Merrill Edge will charge you $6.95 for every trade. So Robinhood doesn't charge you commission for any trade. So there are lots of different benefits of each of the brokerages.
So why did you choose Fidelity?
For me, everything, all my retirement accounts are within Fidelity. It's easy to see everything in one.
Yeah, mine 401 is in Fidelity.
Yeah. Okay. All right. So here it'll ask you the transaction type, right? Am I buying a stock or an ETF? And I'll explain what ETF is after the break. Mutual funds, fixed income, like there's just a bunch of stuff. So I typically just stick to stocks or ETFs. Then you can put in the symbol. Let's say we want to buy some Apple, right? So then let's say, so it now tells me that Apple is trading at $213.26, right? So I can say I want to buy Apple stock. When I'm buying it from somebody else who already has Apple stock, and they are selling. Yes, right. So I'm buying, they're selling. Okay. So then the next thing is, how much do I want to buy? Let's say I want to buy 10. Right? Next thing I have to figure out is my order type. There are lots of different order types, but the ones that I want you guys to remember is your market order and your limit order. Those are the two that I use the most, right? So a market order just tells me, I want you to execute this order. I want you to execute this purchase at whatever the market price is. So if the market opens, if you go back into your, go to your app real quick. Go look at Apple, which is AAPO. Let's say this was on Friday. We're going to execute this order on Friday. Do you see where it says open? You guys see where it says open in your app? Remember, who can tell me what it opened at?
214.
Yes, $214.05. Okay? If I place this order and I say I want you to execute upon open, then if I had placed this order on Friday, it would have executed it at the market price, which was $214.05. All right? Make sense? And so if I'm buying 10, then that's an estimate of $2,114 and whatever. All right?
Can I ask this?
Yes.
Is it possible, I mean, this is just playing around now. Is it possible for you to see a sale or, something like a transaction? You don't buy it, but you have a place where you can pretend as if you bought it, and you can come back 1 month later to see, wow.
There's an app that.
There's
you
an
can do
app.
that with.
There's an app.
There's an
Yes.
app.
I was gonna say not with these ones.
But there is an
I
app.
can't remember off the top of my
I
head.
have it somewhere.
It's basically a modeling.
Yeah, I've seen that before.
That
Yeah.
would be really good. I mean, you can see, whoa, would I have lost money? Would I have made
It's
money?
a good practice too.
Mm-hmm.
Yeah.
Absolutely. Okay, so remember I said market orders. Now the other one you can have is a limit order, okay? I tend to use limit order because what this says is that I want you to execute at this price. You set the price you want to buy Apple at, okay? If I'm looking at Apple at $213, I'm like, oh, I don't want to pay $213. I want to pay, let's say, $190. I can set that limit. So if Apple gets to 190, I want you to execute this, okay? The next thing you can do is that you now can say, what is the time frame I want this order to execute in, okay? There is the day. I typically use a day or what is called good to cancel. There's so many of them, right? So a day means that if Apple drops to $190 within that 24-hour time frame, execute it, okay? There's another one, good till cancel, which is what I tend to use, is that, look, this order stands for the next 6 months. If Apple ever drops to $190, I want you to execute this order, okay? Make sense? All right. So So when you are buying, the asking price, right? It's just like with if you were in real estate, the asking price is basically in that instance, my asking price was 190, and then she has a selling price. The same way you can set a limit on purchases, you can also set a limit on selling. So let's say, go back here, instead of buying, I want to sell. You can do things, I want to sell all my shares, I want to sell just a portion of my shares. So let's say I wanted to sell 10, right? I can sell 10 at the market price. So $213.26. That's how much it is today. I don't know what it's going to execute at, but it's going to execute around there. If that's good enough for me, that's good enough for me. I can also set a limit to say, I don't know what Apple is, but this is part of when you're putting your strategy together. Let's say you bought Apple at 190, and if Apple ever gets to $250, I want you to execute this order immediately. So I execute this order, and I say this order stands for, it's good to cancel for the next 6 months. And you can actually also set an alert to say that, hey, the order is about to expire, etc.
Do you do that sometimes?
Yeah, I do. Yeah. I put in sales orders. I see them get all the way close to it and then come back down, and I'm like, dang it. All right. That's clear? Okay. Yes.
And I think I have asked you this before. One of the things, and this is a little personal, okay. One of the things that has baffled me about you and that I've asked you is, Loretta, how are you doing your job?
My dad doesn't think I work. My dad doesn't think I do anything at work because I'm always sending him articles and stuff.
I mean,
I can assure you
how,
she works.
how are you able to be working and doing your work well, and yet you're monitoring all this, you're checking all this, you're placing orders, you are, I mean, just for the benefit of all, how do you...
I set a lot of limit orders. But then remember, so here's where the apps are good, right? These apps send me notifications all the time. So if Jerome Powell is supposed to come out and speak, right, it'll send me a notification. The jobs report was just released on Friday. I get a notification for what the jobs report's at. So that's part of the reason why I use the app, is that it helps me to focus on what's important. Once you create that watch list, it now just automatically sends you notifications according to the watch list that you've put together. Make sense? Yes?
Why is it that, going back to the market order stuff questions, why is it that sometimes different platforms have different price on the same stock?
They shouldn't. If it's trading on for a market, the market price is the market price. It shouldn't matter what the platform you're using, whether I'm using TD Ameritrade or whatever. Now, however, what you might be seeing is that some of them might have like a 20-minute lag or a 10-minute lag or whatever. But the market price when that stock executes is the market price. Now, where you'll see the difference is in the commissions. Yeah, in the fee. So let's say here, so you see here it says cash I have available to trade at $0, settle cash, whatever. But if I was to buy, and let's say it's good to cancel, I don't think it's going to let me show it because I have no money in here. Yeah. Limit price, sorry.
So do you usually like keep money in there?
Yes.
I guess if you put a forward order in, you would have to have money in there.
Yes, you have to. For it will not let you execute on an order unless there's cash there. We don't have pretend money in these things. Yeah, can you see here? Can you see here? It's telling me. It's telling me that the order estimate exceeds my cash available to trade. So I don't have the cash in here for it. But what the one difference that you'll see across the different platforms is how much they charge you for a commission. So like I said, Fidelity is $4.95. E-Trade, I think E-Trade is $4.95. Robinhood, I think, is $0. So it just depends on which one you decide to use. Yeah, Robinhood is $0. No. Why? How is?
Your question again.
I said, why is Robinhood different? What are they doing that's different?
Robinhood is trying to be like Robinhood, I guess. I don't know. I honestly don't know how they make money off their platform. I haven't traded on Robinhood, but I do know that they charge $0 commissions. So I honestly don't know. Yeah.
They kind of came in at the start of these kind of platforms are trying to, be tech savvy and do it. So that's the pitch. I have no idea how people can I also use Robinhood. So.
And the other thing is that a lot of the bigger mutual funds or managers, because I think Robinhood is also targeted to like the average people who want to get their feet wet with investing but aren't really trading lots of huge volume. So that's my guess, honestly, but I'm not sure. Everybody's downloading Robinhood. Everybody. Okay, the one thing before we go on break, I want to make sure you guys understand. Who works here for a public company? You work for a public company. All right. I think I said this last time. Participate in your ESPP. But I wanted to also say that participate in your ESPP before saving, right? And here's why I say that. If let's say that you are trying to build up, you don't have up to 6 months worth of cash right now, but you're trying to build it up, right? ESPP is a guaranteed way to be able to build up that investment and also get interest on your money, okay, if you sell immediately. So with a lot of ESPPs, what they do is that they have an option period. So a lot of companies is 3 months, so every quarter. Some companies is 6 months. My company is 6 months. At the way traditional companies, because our company does it different, the way traditional companies does it is that at the end of the option period, so let's say for this third quarter on September the 30th, or if September the 30th is on a Saturday, on whatever that Friday, the closing price is what they're buying you the stock at, and they give it to you at a 15% discount, okay? If you get that stock at a 15% discount, what has your money done? Exactly, your money has grown 15%. Can you get that in a savings account? No. Exactly. Now, the flip side you have to remember is that if you sell immediately, you're going to pay taxes on it. It's called capital gains tax. However, you're paying capital gains tax on your whatever your income is. And if we get a chance at the end, I'll try to explain a little bit about how the tax bracket and everything works. But I highly recommend everybody here, if you can, max out your ESPP before saving. And then once you get that asset, sell the asset, take that money, and go put it in savings. I don't think you should leave that money in your ESPP unless you plan on holding that long term. Okay?
If your company has a negative P/E ratio,
Huh?
if your company has a negative
Don't
P/E
matter.
ratio,
Yeah. As long as they offer you SPP, it's free money.
So they have to offer it.
No, they don't have to. If not all,
I'm not aware of my company. I work for a
ask,
company.
check with your HR department. All your HR departments should let you guys know if they do. The majority of publicly traded company offer ESPP, but it's free money. Okay.
Does it come with the, so if you're new to a company, you have to be there for a certain amount?
No.
Okay.
As long as you're there before the option period, most of them let you participate in it.
Gotcha.
You can't be a contractor though. You need to be a full employee. I know. You need to be a full employee. All right. Before we get into mutual funds, let's go ahead and let's take a break. Let you guys stretch your legs a little bit. It's 10:28 a.m. So let's take a 10-minute break. We'll come back at 10:40.
So, back to that ESPP thing.
Mm-hmm.
My company, we just specifically purchased a lot of it. I mean, like, we invested, like, the trading period was over, and, like,
Careful.
my contribution